Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, this is Rahul Shah here, trying to make investing accessible and profitable for the average investor. Things are not looking good for the market. As I'm recording this, the Sensex is down almost 1400 points from Friday's closing. Zoom out a little and you realize that the index is now 11% off from its all-time highs reached earlier this year. Therefore, technically, we are not in a bear market yet. A bear market is defined as a market that's down at least 20% from its top. Thus, we're just halfway there. But few more days like this and who knows, we may be within a kissing distance of one. Anyways, the purpose of this video is not to scare you, but to highlight how it's very important to have a certain system in place while investing. Because if you don't have one, you may panic and end up taking wrong decisions that could then prove dangerous for your long-term wealth creation goals. Okay, so let's take this step by step. It's very important to ask yourself, what is your long-term objective of investing in the stock market? Now, if you are an SIP investor and you don't need the money over the next 10 years, then you need to continue with your SIPs. The very objective of SIPs is to not time the market and keep allocating a fixed sum every month so that you encash on the long-term India growth story. Please note that the long-term India growth story is intact. I am quite confident that Sensex will be creating new records every few years. And one of the best ways to capitalize on this is an SIP. So please do not stop your SIPs just because markets are going down. Continue doing them. Now, if you are someone who's been saving up for funding kids' foreign education or for their marriage, and you expect the event to take place over the next 2 to 3 years, then it may still not be too late to book profits equal to the amount that will fulfill these needs. Buying when the markets are cheap and selling when they are expensive is the most rational thing to do in stocks. And even after the 10% correction from the top, I don't think the markets have turned cheap. They are still expensive from a valuation standpoint, and therefore, if you see a big need coming up over the next year or two, you can still book your profits and move the money into an FD where your principal will be safe. As for the other investors, they need to decide whether they'd like to be a business analyst or a security analyst. You need to ask yourself, are you a business analyst or a security analyst? Now, a business analyst takes a call on the business, and as long as the business remains strong and is growing, he does not exit. He will be someone who is interested in an Asian Paints or a Pidilite or a Titan. His focus is on analyzing the competitive advantage of the business and its growth prospects, and if he thinks these qualities are intact, he seldom sells. He is more in the Warren Buffett mold, where average holding periods range from 5 years to 10 years and even 20 years. Now, coming to security analyst, which I like to call myself, we operate under the belief that every stock, in fact not every stock, but most of the stocks are attractive at one price point and expensive at another. We are firm believers in valuation. We are not business analysts who don't touch anything that's not great quality. We believe that even an average quality business can turn into a great investment if you buy it at attractive valuations. Our holding periods typically range from 2 to 3 years, where we aim to make 50 to 100% return on a stock and then move on to the next similar stock. So that's how we security analysts operate. Now, business analysts, guys who are buyers of the best and the fastest growing businesses, do not worry that much about the broader market valuation. They only consider the valuations of the businesses they like, and if such businesses become attractive even at the top of a bull market, they will go ahead and buy it. As far as security analysts are concerned, I think it's important for us to take a look at the broader market valuations. This is because we mostly tend to invest in stocks with low PE ratios and low price to book value ratios. And these kinds of stocks are found in abundance in a bear market like they did back in March 2020. So it's important for you to always have some cash at your disposal so that you can, take advantage of such opportunities. Therefore, a lot of security analysts like me, they recommend the following allocation. If you have rupees 100, invest rupees 25 each in stocks and fixed deposits and allocate the remaining rupees 50 between the same asset classes based on market valuations. If the markets are cheap, like they were back in March 2020, allocate the entire rupees 50 to stocks and be rupees 75 in stocks and only 25% in FDs or bonds. And if they turn expensive like they are right now, you can do the reverse, that is only rupees 25 in stocks and 75 in FDs or bonds. Since we are security analysts and since we want to buy stocks on the cheap, the rupees 75 in FDs or bonds can come in really handy when the bear market comes. Of course, one can be conservative and have 50% each in both stocks as well as bonds. And he can keep rebalancing this, say, every 12 months, where if stock becomes 60%, he can sell stocks and move 10% into FDs. And if FDs become 60%, he can move 10% into stocks. Like with most approaches, there is no guarantee that this approach will help you beat the markets over the long term. But you are at least doing the right thing from a long-term perspective. You are increasing exposure to stocks when the markets turn cheap, and you are reducing exposure when they turn expensive. Thus, coming back to the original question, what should you do in this market? As I said, you need to figure out what your objective is. A SIP investor has to continue with his SIPs, while someone else who needs funds over the next 1 to 2 years, he can maybe consider partial exit to the extent of his fund requirement. Lastly, a security analyst may have to increase allocation to stocks if the market falls more from here and invest in low PE and decent quality counters. In our services, I usually prefer a PE ratio in high single digits or low double digits and almost zero debt companies. If you are a business analyst, then you need to pay attention to the quality as well as the valuations of the underlying business. So it's all about the objectives first and your underlying strategy later. As long as you're clear about these things, a market crash or a correction will be the least of your worries. All you need to do is execute the strategy and the rest will follow. Do send in your feedback and comments, and please do subscribe to our channel if you haven't already. I'll see you again next time. Thank you so much.